Hi, morning. Welcome everyone. We'll just give it a minute more as more of our readers join in. And welcome to TLC Asia's last webinar for 2020. If you've joined us for the previous webinars, we've been doing one a month, the last couple of months. Thank you, and thank you for coming back to our last webinar too. I'm going to be discussing a very interesting topic today. It's related to private equity, venture capital, and deal making and the intersection of technology. We're also going to be talking whether tech and solutions like artificial intelligence in particular can drive private equity deal making and decision making. Uh, One thing that when it comes to investing, data is at the heart of investing. So we will sort of look at whether successful investors are relying on a data-driven decision approach, and how much are private equity and venture capital firms, using or underutilizing data and AI. Two quick points before we begin. Sticking to data, at Deal Street Asia, we have a new data newsletter. It's called Data Vantage. It's twice a week. You can expect a lot of data points related to private equity and venture capital, from fundraising, investments, deals. We cover Southeast Asia, we cover Greater China and India, and there's a lot of infographics, charts, and insights. So if you're not subscribed to our new data newsletter, do check it out. I'm sure you'll find it really interesting, both professionally and personally. The second quick point I want to touch upon is, while this is our last webinar, we have one more event at Deal Asia coming up, and that's big for us. That's our annual summit. We do only one event a year. We're not an events company, so we just stick to that one event. So it's a packed 2 days, November 24th, 25th. We have over 70 panelists and speakers. We have a flash sale for tickets that ends Friday, tomorrow, October 16th. So if you haven't picked up a ticket, please do so. And again, that's something that feel extremely valuable. We have a bunch of, and this time, because it's virtual, it's interesting because we have speakers from China, Australia, Southeast Asia, US, and India, and even other geographies. Back to our webinar today. I just want to take a minute to quickly introduce our panelists. Let me thank all three of them, for joining us today. And let me start with Nigel Lee. He's the operating partner with Partners. Over the last 20 years, Nigel has focused on shaping the landscape of financial services, fintech, payments, and digital commerce. And he's been a senior executive of some of the largest multinationals in the industry. And he's largely operated in the developing markets, particularly in Asia. And at Apis, he's been sourcing exciting companies in South and Southeast Asia to add to the fund's portfolio. And before Apis, he was the international head for American Express prepaid mobile and digital launching products. And he's also served as the EVP international for MoneyGram. And prior to that, he did a 5-year stint as president, First Data Asia Pacific. Moving on to Adam Nguyen. He's a co-founder and senior vice president, eBrevia, which is a different company. eBrevia is a leading enterprise contract analysis software company that applies machine learning to automate contract review. And before eBrevia, Adam was a chief of staff and legal officer at a private equity firm called Vantage Properties. That's a 350-member firm with over $2.2 billion of assets under management. And the third panelist that we have today is Abrar, who's the founder and managing partner of Quadria Capital. Abrar has over 20 years in PE experience in PE investment banking and the healthcare sector. And before Quadria, he was the global head of healthcare investment banking at Religa Capital Markets. And prior to that, he was a managing director with Bank of America Merrill Lynch. And their global investment banking group. He's also led a lot of private equity transactions across 3 different continents: Europe, Asia, and the Middle East. It's the same continent as Asia. So let me begin with some of the big picture questions. And I'd also like to add one more line on both Quadria and Apis in terms of where they are as GPs. So Apis closed its second fund at about 563 million last year, December 2019. In terms of Quadria, they closed their 4th fund recently. That was about 600 million. And what's interesting is we had a Deal Street Asia private equity H1 2020 private equity report, and there's an interesting point that the report mentions. It's in the first 6 months of this year, there's only one Southeast Asia focused fund manager has sort of hit the final close, compared to the previous quarters where it was an average of 3, and that's Quadria, which closed recently their fourth fund at about 600 million. So thank you all for joining us. Thank you to all our readers who are part of this panel. We will make sure that you get the video and the complete transcript within the next 2-3 days after the session. So let me just move on to start with some big picture questions. Nigel, can I start with you? So,
yeah, sure.
I just wanted to sort of set the context, look at a very broad big picture, in the sense in the last 8 to 10 months, what's really changed in terms of deal making for Epis? Like, has your investment speed or strategy changed? Are there certain sectors that have become more interesting when compared to, let's say, the same time last year? Or are there certain geographies that have become more interesting?
Yeah. Look, first of all, thanks for having us on the panel, and hopefully it's going to be an interesting discussion, and we can share some of our insights as well, Joji. I mean, last 8 to 10 months obviously been an interesting and challenging 10 months for pretty much everybody, for different reasons. For us, it's if you ask, has the strategy for the fund changed? The answer to that's really no. And to explain why, the fund basically focuses on financial services in the emerging markets and largely fintech enabled, so capital light financial services. It means that whilst many other people have been focused on B2C investments in financial services, in fact, fintech has almost been largely monikered as a B2C play if you go talk to people. Actually, for us, we've tended to focus much more on the B2B space, as you know from many of the portfolio companies that we have. And that means that we have been investing in infrastructure plays that rise with the tide of electronic transactions as much as anything else, or electronic financial services. So we've seen that strategy, frankly, being played out and supported by what's happened over the last 8 to 10 months. We've seen that actually companies in that space have grown dramatically or have not seen the downside, perhaps, that physically based commerce has seen. So for us, the strategy has remained pretty similar. Speed of deal and speed of deployment, slightly different. I mean, I think we've been able to, our aim has been to do probably a couple of deals every 6 months. And we have, we closed our last deal the tail end of last year, but we closed three really in the second fund since its first close, which was sort of about July, August 2019. So we kind of built up a head of steam going into the period of COVID. We have not gone through and closed the deal in that interim period, actually. And so in some sense, that means that deals in our views have slowed down. Partly, though, that's been partly our choosing. Right? I think we've taken a call that says we need a couple of quarters of new information on companies that perhaps we're talking to try to understand where they're going to land in order to make sure that the valuation expectations that we're putting out are sensible. So I think deal closing has probably slowed. Strategy hasn't changed. Sector focus, we have probably backed away from items in the lending sector, and in particular in Indonesia, where we've seen, we did a lot of work looking at P2P lending and the and supply chain lending over the last 18 months, 2 years, and I think we decided not to make investments in there until we got more info. We said it was a nascent sector. We know that sector is hurting now. We'll come back to it, I suspect, in 12, 18 months. And then in geography, really geography for us hasn't changed. I mean, many people might think we're mad or brave or make a choice by being involved anyway in places like Africa and in some of the more emerging Asia countries. But the truth is, being a sector specialist helps us, and being a specialist in the emerging markets when you're a sector specialist means that you continue down that track. We've done enough of a scan of the market to know what works and what doesn't. So I think big picture, deal speed has changed, but not necessarily because there aren't deals there to do. I think it's because we've chosen to slow it down and see what the outcome in the market's looking like in terms of real economy impacts on the businesses we've looked at.
Got it. Thanks, Nigel. Abrar, let me come to you. What's really changed for Quadria, considering that you largely do health tech, med tech, hospitals, pharma? I'm assuming that this must be the best phase of deal making for Quadria. So has the pandemic thrown up opportunities that may have taken a lot more time to emerge, if not for it?
Yeah, thanks, Joji, and thanks for having me on the panel again. Look, we're living in unprecedented times, and we're living in a crisis that affects, I think, all of us. And being an investor in healthcare, we're very much at the forefront of dealing with this pandemic. And to a large extent, many of our businesses have to kind of rise to this opportunity, rise to the challenge of what's going on in the economy. That said, frankly, there has been a huge amount of capital that's been coming towards healthcare over a period of time, and that predates COVID. Just to give you context, about 10 years ago, of the private equity capital that flowed into healthcare, about 10 years ago, it was about 5%. Over the last 2 years, it's actually been the second largest sector after technology at about 15%. So we've seen a huge flow of capital coming into it. And I think now, given COVID, we're going to see an even more amount of money coming into it. And it's not just the private sector, but also the public sector. Clearly, given the considerations of what's going on, to some extent, people are calling healthcare now as the new defense industry. So we think that's positive. Has that accelerated deal flow? Unfortunately, no. Has that created greater opportunities? Probably, but we don't know yet. I think that many of the businesses that have been in the healthcare industry have gone through phases, and those phases are not finished. I think the first phase was, of course, led by safety, led by capitalization, ensuring that the supply chain remained strong, ensuring that the balance sheet remained resilient. The numbers of patients coming into hospitals, particularly for elective or chronic disease, fell off a cliff that made operations very, very difficult. Certain parts of the health ecosystem benefited dramatically, whether it's devices, whether it's diagnostics, whether it's drugs. But the impact overall has been dramatic. Now, here's the hardest part for us as an investor to figure out. The fact essentially is that our customers and our patients have changed. Their behavior has changed. The way that they access our products has changed. And we have not yet fully understood the full consequences of that change. Is this a short-term change? Is this a long-term change? And it probably takes us months, maybe even years to fully understand that. And if that behavioral change continues, then the opportunities will also change. By definition, businesses that are at healthcare at home, telemedicine, technology-led, will benefit in that long-term trend. Whereas the infrastructure hospitals with physical space may suffer, but we really don't know that yet. So as far as opportunities are concerned, we continue to see a huge amount of opportunities, but we're also seeing at the same time many players in the healthcare space, particularly those that weren't very well capitalized going into COVID, that probably didn't have scale, come under a lot of pressure. And as a consequence, we hope that there's going to be a lot of consolidation. It hasn't happened yet.
Interesting. Adam, just let me come to you from a very broad perspective. Since you deal with so many GPs, have you seen any changes in terms of private equity deal making in calendar year 2020? And also, has the pandemic really impacted the demand for your services?
It's interesting. We're sort of like the canary in the mines. And just for the audience to know, the reason for that is eBrevia, as you mentioned before, uses AI to analyze contracts, right? So automatically speed up the process of contract review. So of course, part of the deal making, in the deal making world, we're front and center in terms of providing quick and accurate due diligence. So we're at the beginning of that stage. So what I've seen at eBrevia, that there has been a pause in terms of deal making. That said, I think there's a lot of liquidity out there, and of course, governments around the world, given interest rates and what the Fed's doing, basically propping up the market. So we have an issue with valuation as well, right? So a lot of parties are sitting around. On the one hand, you have a lot of dry powder to go on, but on the other hand, the question of valuation. And is it a good deal to buy, a good deal and a good time to buy companies? And so what we're seeing at eBrevia is that GPs are coming in and kicking the tires and doing preliminary diligence review without committing, or without going to term sheet even. So actually with technology like AI, you're able to do that, right, quickly and cheaply, so that you don't have to bring on an entire law firm and go through an expensive diligence exercise to sort of preliminarily value a company. So, in case, 6 months from now, things change, interest rate changes, then GPs can pull the trigger. But I'm seeing a lot of prep work, but deals are not really happening. And I think that anyone, they happen, I would be very, frankly, anyone really going to happen in the next 3 or 6 months.
Got it. Adam, I just have a follow-up question for you before I go to Nigel and Abrar. You sort of mentioned in terms of how tech can help, but have you actually seen over the last, say, 8 to 10 months that technology adoption by PE firms and VC firms, have they sort of increased sharply, during these times? On broadly, are a lot of PE and VC firms, are they even equipped to sort of use some of the technologies that you talked about?
What we're seeing is a divergence in this space, and even before COVID, right? And I think COVID really exacerbates this phenomenon, this divergence. And so you have the big players that, like the KKRs of the world, that are investing heavily in technology as they scale, right? And part of that is AI as well as non-AI technology. And, we are seeing that, especially from the larger players. And then, on the other end of the spectrum, you just have smaller players that perhaps because of the lack of resources, or, their focus on growing their AUM and finding deals, that they're not really focused on the long-term strategy and building a solid foundation for their business using technology. So, I see with COVID, I'm seeing more and more people, the clients that are coming to us tend to be the larger PEs. And apart from PEs, just larger players in the market, the big law firms, the big accounting firms, the large corporates. So that's an interesting trend that I'm seeing in the marketplace.
Yeah. Nigel, let me come back to you and touch upon something that you had said in your opening remarks. This recession, most analysts say that unlike previous, displacements or recessions, the pandemic may probably or definitely will have second order effects. It can have long-term effects on everything from business models to consumer behavior to national and local policies, operations of PE, VC firms and all of that. So when you look at sort of your portfolio, when you look at deal making during these times, for private equity players, is the strategy now to sort of look for long-term survivors, or rather than looking for short-term winners? Because there are a lot of short-term winners during the COVID, but the PE strategy, does it change to find long-term survivors?
Yeah. Look, the answer to that is that the PE strategy is always, I think, about long-term survivors. The truth is, our fund timeframes are 10 years, our investment holding periods are kind of 5 years, and depending on macro conditions, 5+1. So our view is you have to buy long term. If I think about what that means now, long term businesses in the financial services sector, that are going to be benefiting from what has happened due to some of the changes. They're going to be businesses that are going to be predominantly supporting a digital change in financial services. As an example, we've got a variety of different businesses, ranging from lending businesses in Africa through to health insurance in India in the portfolio. We recently invested in a company called Coda Payments, which is one of the Singapore fintech companies, and its payment basis is payment for the emerging markets, so non-credit card related payments generally, although it does accept them. But the major products are digital products, gaming, entertainment, etc. We know that sector is clearly an important sector for the future, period. And that's why we invested. It has had an accelerant as a result of what's happened with COVID. I mean, everybody's staying at home, right? So the result of that means that people are spending more time on gaming, using e-product and entertainment more frequently, and therefore having to pay for it. And more electronic payment, because previously they might have had to go down to somewhere local in order to put cash into a wallet in order to be able to pay for their games. Now they actually can transfer and will transfer directly from bank, partly because they can't get out. So yes, we believe that there are sectors that will be benefiting and changing dramatically as a result of what's happened, and that for us, it means that we need to be more critical about ensuring that we invest in those sectors more thoughtfully. So there definitely are changes for us. It doesn't change what we think. We still think P is a long-term game. P isn't, VC, increase the multiple by 5 and ship it out the door. We really are there to be able to grow businesses, over a 5-year period. But the starting point actually is interesting at the moment.
Got it. Abrar, how do you look at it? Because you are in your 4th fund now. You mentioned about how health tech and medtech hospitals, all of this have become vital. You have a lot of players rushing into the space now, especially in these times, because it's been a sector that has become really hot. And therefore, how do you sort of pick up long-term survivors in this space? And can technology help you make decisions here?
Yeah, look, I mean, it's a question we're thinking about actually as we speak, because I do think, given that we're living through a COVID time period, and given the fact that we're going to have to do things like this, which is Zoom calls, not just with folks like yourselves, but entrepreneurs and other companies, it's allowed us to do a little bit of an introspection around what's the best way to use technology, what's the best way to actually pick the winners of the future. And, one observation I'd like to make, which is actually quite sad, which is, illustrating how old I am. When I first started into this industry, Excel was new adoption, early 90s. And, even when I started using Excel as a young analyst, it wasn't fully adopted for a while. Even in the investment banks or even in the early private equity firms, people were still preferring to do analysis in a very different way. But what's startling actually is that to a large extent, a lot of private equity funds are still run by Excel, 20, 30 years down the road. And I do think that this should not be our Kodak moment where, we keep beating up our portfolio companies and saying, guys, digitize, guys, think about ways to engage with your customers, your patients, your end users in a lot more effective way. Whereas we as investors ourselves are perhaps not driving that going forward. So I do think that there has been an introspection, certainly within our firm, and what we've done. And, Adam can probably completely disagree with me and say that we're approaching it wrongly, given the fact that they've done this. But the way that we've tried to do it and to say, look, what data do we have around the markets in which we're investing? What data do we have around some of the companies that we're excited about? How do we predict the winners are going to be? And how can we use artificial intelligence? Frankly, when we began, we had no idea. So we started working with a local university, trying to think about how artificial intelligence would help. We were quickly told there are 2 big types of artificial intelligence, which is artificial narrow intelligence, which is just basically analyzing data. But the real art is going to be in something called artificial general intelligence. I'm probably giving away my ignorance rather than my knowledge, Adam, but it was the artificial general intelligence, which was far more exciting, which is something a bit more predictive, something that takes data historically, takes data and growth rates, consumer trends, all of that, analyzes that, and then gives us a better way to predict which companies will emerge as winners. We think that's extremely exciting. If that is a new insight that we can leverage, that will definitely revolutionize the way that we do business. Usually, whenever we go and meet with entrepreneurs, we're given a hockey stick projection. It doesn't matter what company it is, what business it's in. If they've been growing at about 15% growth rate, the projections that we'll get is about a 40% growth rate going forward. If they've been growing at 5%, they'll say we're growing at 25% going forward. Now, you can have the Excel mindset that we've always had over the last 20, 30 years, or we can try to bring something new. It hasn't worked yet, but we're hopeful that we'll get some tool that'll help us navigate this going forward.
Got it.
So, sorry, I just wanted to say, Abrar, after that comment about the hockey stick, it's really interesting, having been involved in running a strategic, major businesses, that actually you find your business managers internally do exactly the opposite. They're more than happy to downplay their budget numbers. And now when I come to the other side and look at companies that we're going to buy, it's always the case that their numbers are generally overstated. It's really quite an interesting corollary.
Yeah, exactly. So, Adam, what's your take on what both Abrar and Nigel have said? Do you think that when it comes to GPs, their familiarity with technology, regardless of which domains they're operating in, is a unique advantage going forward?
I think, I hate to say this, but by and large, GPs are not familiar with technology, right? Because so much of VC and private equity deals historically have been successful because of relationships, like interpersonal relationships, and who do you know in the industry and so forth. And certainly, where I'm coming from, New York, and what I've seen in Silicon Valley, that's very true. But there's certainly, going forward now, there is a role for technology. There's a role for AI, and Abrar mentioned earlier, a lot of funds are still using Excel to track their portfolio fund performance, and then at the portfolio company level, the companies are tracking their documents, obligations and risk and liabilities using Excel spreadsheet. And at the end of the day, nobody really knows what's going on in the company, right? And so I think in terms of looking at adopting technology, my recommendation based on what I've seen is that, to find narrow niches in your company where you can start making improvement. One of the mistakes that not just GPs, but, corporates have is they try to solve everything at once, right? Finding the perfect solution that doesn't really exist. And as powerful as AI is, there are limitations, like including, the need to train the algorithm for the machine to learn, and then the access to data. Where is the data coming from? How much data do you need? You talk about historical data on investments that perform well. Well, what are the traits in those investments? What are the variables, and what weights do you give to certain variables? Well, all those things need to be programmed into the AI, right? So yeah, I think that you have to manage expectations, and then it's a process. So it starts with adopting the technology, learning what it can do, and deploying it through different aspects of the organization. The way I look at it, in terms of PE, there is the front end, the transactional, the acquisition, the due diligence side of things, where you can deploy technology. And then after acquisition, how do you manage the companies that you acquired, right? And then the third phase is the disposition of the assets, the exit, 5 years, 7 years, 10 years, or whatever. Upon exit, what can you do at that stage in terms of technology, deploying technology? And in terms of eBrevia personally, that's where we look at things. Like we look at unstructured data, textual language in contracts at the various stages that I just described. But there is a role for technology, but you have to manage your expectations. And I think GP, in their ambition to do things quickly, to solve all problems at once, often get stuck with inaction because they're unable to decide on the course of technology to use.
Got it.
Can I, Georgie? Can I respond to that? Is that okay?
Sure, please. Yes.
Yeah. Look, I mean, Adam, just to kind of deviate a little bit and disagree with you, if I may, because we said earlier we are going to disagree with each other. So, look, we respect and we acknowledge that technology can be a great enabler and all of the elements that you identified. And in fact, we're trying to work on that. We're trying to figure out better ways to predict the companies that will be winners, find better ways to monitor those businesses, and also find better ways to monetize those businesses. But just let's be clear. Our business is a relationship business. Our business is to identify companies with whom we can partner with, right? And because we represent capital and potentially some operating value, but primarily capital, we're not the only ones who represent capital. An entrepreneur has a variety of different choices out there, whether to take money from us, our neighbors, the capital markets, or the debt markets. So we have to differentiate. And the best way to differentiate is, unfortunately, a relationship. It's building a relationship with that individual, which is way beyond any technology. And in fact, even with Zoom, it's very difficult to build chemistry or an individual relationship with an entrepreneur and compare that with a relationship that you can build over various meetings, dinners, getting to know his wife, his kids, and their aspirations. And honestly, if I take a step back and I say, in my entire career, which companies have really succeeded? It's the ones where we've had the best relationships with the entrepreneurs. It's ones where we've had the greatest trust, where that trust translates from the entrepreneur to us and from us to the entrepreneur. And as a consequence of that, that's something that technology, I wish, can help with. But so far, I don't think it can. And in fact, that's probably the main reason that deal flow is slowed because of COVID, because theoretically, we can still do meetings with entrepreneurs. Theoretically, we can still do virtual due diligence. We can look at all the data that we can through the data room. But can I build that trust? Because counterparty risk with the individual that we're investing in, is the biggest risk that any one of us investors take. And that's where the biggest limitation of technology really comes. But it's also where we, as individuals, hopefully make our money, because we'll say, you know what? That's my gut. I can feel I can work with this guy, or I can work with this family. I can work with this entrepreneur. And that's something that hopefully we still need to hone our skills on, but it's out there.
Got it. So
and I know, like, just a note on that. I think we said earlier that we would disagree, but in this case, I will agree with you. And I should point out that AI and technology is not there to replace the human component, right? And in no way do we say that we are taking over the entire human value chain. But what we do say is that for especially repetitive, inefficient tasks, technology like eBrevia can speed up, for example, the contract diligence review process, right? So, speaking of trust and relationship, after you get past that hurdle, and let's say you find yourself in an auction situation, auction bid situation, it's incumbent upon you, after having a good relationship with the founders, to move quickly. And so, having been a founder myself, one of the pain points that we went through, when we were looking at investors, is like how slowly they move, right? And so you may have a good relationship at the beginning, but the proof is in the pudding, right? So can you move quickly? Can you review documents quickly and make a decision? Get back to us one way or another. But in my when I was running eBrevia as a co-founder there, it was very frustrating to see VCs drag their feet. They just didn't get the diligence completed in time. Meanwhile, we're burning through cash. We needed to move forward. So I think that's where technology can come in. The processes that are bogging down and taking away from exactly what you just said. Building the relationships between PEs and founders.
So Adam, and Joji, I'm going to hijack this as well, because I think it's very interesting. It was something that I think Abrar said earlier, which is that basically it's a relationship business that helps sort out the wheat from the chaff in terms of deals, is absolutely right. And you refer to the fact that actually as investors, we expect to go on and invest and help improve the companies we invest in. But Yeah, the old saying that don't go and use the toilet in the plumber's house is very true here. There are, for the most part, most of the time I've talked to GPs, they frankly rely on the fact that life is about relationships and individual sales individuals, if you like, deal-making individuals, rather than support in the infrastructure behind them for technology. In fact, actually, many funds themselves run on Excel spreadsheets. They don't just use Excel to analyze companies, they actually run on Excel spreadsheets. And it's insane, right? So, yeah, a lot of the infrastructure that most corporate sectors have employed in order to improve themselves, put AI aside for a second, does not really turn up in infrastructure in funds. And I think going forward, in what my experience working with companies and working in the consumer sectors with companies is that if you haven't got data, if data is not visible, you can't make decisions, therefore it may as well not exist. And actually for us, for example, we now look at our infrastructure for sales sourcing, which our front end systems that we installed a couple of years ago. And we have over 1,300 companies that we haven't been back to talk to in the last 6 to 12 months. You know, to the point that Abrar made about introspection, actually now people are beginning to realize in times of COVID, it's much easier to go back and re-talk to those companies and understand where they are in the cycles, where their last deal was, than it is to try and go knock on new doors, because physically you can't go and do that to the same degree. So oddly enough, COVID is forcing us to go back and look at the way we source deals based on technology, rather than necessarily only based on the last person I had a meal with who said there was perhaps a good deal coming up over here. So I think GPs actually do have to get better at being able to use technology. I think when you're doing a full buyout, like a KKR, and you've got a company with hundreds of thousands of contracts, you absolutely need to find a better way to go through them than employing an army of lawyers. So I think there are definitely increasingly use cases for GPs to just improve the way they use.
Got it. I think broadly we all agree that when it comes to that relationships and trust in these meetings, it just adds an additional layer of comfort before GPs commit capital. But and again, tech can smoothen the process. But I just want to go back to at the GP level and look at it from a slightly different perspective, because as private equity firms, you know, I'm a big part of your work as much as doing deals and finding companies is also raising money for yourselves, for your funds. So therefore, to both Abrar and Nigel, I just wanted to ask you, like, in the sense, how do you see it? Like in LPs, for instance, they do have a lot of data on fund performance. They do have a lot of data when it comes to returns and all of that. But have you sort of, in your interaction with LPs, a lot of GPs still say that LPs rely very little on tech, sort of, they don't run these data on tech platforms or use this data, or when, you know, sort of evaluating whether to commit capital to their existing portfolio of GPs, or even when sort of looking at new managers. What's it that you're seeing with in the LP space? Abrar, you want to go first?
Yeah, sure. Look, it's a hard one. I think that one of the first issues that a lot of LPs have with private equity is that GPs tend to only meet with LPs when they're fundraising, when they're in that fundraising cycle, and therefore only share the information at that point in time. And then at that point in time, even the information there is very selective even. And then the second criticism that a lot of LPs have is that even if they've invested, whilst the flow of information is okay, it's just okay. It is the bare minimum quarterly report and then an annual report. And then there isn't enough data around how have your deals done, much more in detail, both operationally, and more importantly, have they done versus your original plan, which is, you know, something that, you know, a lot of GPs tend not to want to share. And then the second part of also is how the deals that you walked away from, where you've charged the LP the broken deal costs, how have they done? have you made a good decision by not investing? Have you actually made a bad decision by not investing? So I would say now LPs have become far more sophisticated. So they get the data from folks like PEI, or they'll get the data from folks like Cambridge Associates, which gives them a broader view of the market and market performance of GPs. But what they're really seeking is granular, candid information from the GPs themselves. And certainly, I think there is a little bit of resistance amongst GPs. I'm a GP myself. So whilst we want to give as much data as possible, giving away proprietary company information that is very granular has a risk of getting into competition, has a risk of actually creating some barriers. I do think, again, technology can play a very important role going forward in fixing both those two gaps. And whilst we're trying to work towards that and creating a new kind of dashboard for LPs to look at us and say, look, even if we mask the names of the companies, you can get a very granular view of how these businesses have done. You get a granular view of how they've done against our original plan. You get a granular view of all the stuff that we've walked away from. That we certainly hope improves our transparency, and ultimately, as long as we've made the right decisions, improves the confidence that the LP has in us. But certainly what we're trying to do here is get rid of that opaque shadow that covers private equity. A lot of private equity firms are criticized of being a blind pool asset class with very little information flow, and we're trying to uncover that. And I do think technology plays a very important part in shedding some illumination on this.
Got it. Nigel, how do you see it? Do you see a scenario where, because for instance, sticking to LPs, because they use very little data, many of the LPs sort of tend to go back to the GPs that they've invested in a couple of times, so they're more comfortable with? And does that sort of make it put the newer managers who are in their first or second fund at a disadvantage? And sort of, if LPs maybe use more tech, do you think this problem can possibly be addressed?
No, yeah, that is actually the interesting question, and I'll agree with you, Abrar, that it is almost the responsibility of the GPs to take a sort of, I guess, a thesis-based approach of more transparency will be good for us with our current LPs, and therefore hopefully we'll get them to want to continue to support us going forward. But I think your point's right, Joji, that LPs themselves are not very technologically sophisticated when it comes to wanting to look across information pools and make decisions that way, and so they do revert back to managers who have delivered in the past. And I think that makes it extremely difficult for new managers to be able to go out and raise funds, particularly at this point in time, because you can be thesis-based and go out to or theme-based fund and go out to the pool of LPs out there, but frankly, they're going to basically default back to where they think their money has been best handled in the past. And so, can it help? Well, it can, but it's difficult to see who's going to take an initiative to pull the information from a group of GPs in order to be able to make that normalized such that it can be consumed by LPs properly. And that's I think the challenge. The likes of the PitchBooks of this world and the CBI Insights and others and people like Deal Street are in a position maybe to do some of that. But to the point Adam made earlier when we were on the pre-call, that information is inaccurate and oftentimes just not true. And so it's difficult. Hence the reason that I think LPs default to what they know already.
Got it. Adam, what's your take? When it comes to the LP GP dynamics, what role can tech really play?
Yeah, so I'm less optimistic when it comes to LP and technology. If GPs are still using Excel to run their businesses, I mean, when it comes to LPs, and we have to talk about LP. There are different types of LPs, obviously. There are the endowments and pension funds and foundations, and then, there are family offices, and the family offices barely touch technology, right? And then when you talk about the CalPERS of the world, I'm not sure they adopt technology either. And so they revert exactly to what Nigel and Abrar was saying earlier, to go back to the track record. That's the first thing that they look at. They look at the track record. They look at the team, right? So if your name is recognized, you came from a prior fund that might help you. But it's very, very hard for new VCs or new entrants into the marketplace to get quality LPs without that personal relationship. So, going back to that, yes, there is absolutely limits to technology. And in this case, the LP GP dynamic, that's where I see the limits play out. You have to resort to personal relationships.
Got it.
I need to go back and correct the thinking on one of the comments I made as well, Joji. Adam, I should probably say as well, we as a fund actually have invested significantly in technology, and even though we're still relatively young, I mean, only in our second/third if you take the VC fund. So we have invested in front-end technology to make sure we can manage the deal capture process and the management through, and middle office technology to manage the portfolio companies and look at the risk associated with the portfolio for exactly the reasons that that Abrar and you and yourself described, which is that actually, if we're going to be a successful fund going forward, we actually need to have more information about the marketplace and about what we're doing with our current portfolio. But I would say that from my understanding of talking to many funds, we are probably more an exception than the rule there, and putting an emphasis on trying to do that.
Got it. We have some subscriber questions. If you have if you are an audience listening in, please feel free to put your questions in the Q&A box. I will take it in the last 10 minutes. Just one more round of quick questions before we take a look at some of the questions that have come in. I think I'll start with both, again, Abrar and Nigel here. In this case, like both of you, we've talked a lot about the private equity space, but both of you also have venture capital arms. Now, specifically for venture capital, especially for early stage investments, where a lot of data may not be available, can VCs use AI, machine learning, or tech to sort of better navigate potential deals or find deals in terms of due diligence? Either of you can, Abrar or Nigel, either of you can take it in terms of the VC and the tech part.
Yeah, I'm happy to go first. Look, I certainly think what we're trying to do is get much more predictive around using technology to help us find the right platforms or the right opportunities in the VC space. So look, the one part which is relatively easier is using technology and potentially even AI to predict what are the big themes for growth going forward. What is patient behavior or customer behavior, which helps us predict that one type of business is better positioned than another. That gives us a much clearer perspective of going forward over the next 5 years. Here's going to be the 2 or 3 big themes that are going to succeed. However, that has not yet, unfortunately, helped and translate into which specific businesses within those platforms or within those themes is best positioned to succeed because of the lack of data. 99% of the businesses that are operating in that space or competing in that space are private. They hold their data very confidentially. They won't share with you the number of patients they have. They won't share with you, what's their uptake of the product they're selling, or whatever the key statistic is. You won't find that data in the public domain. Whether we can think cleverly and think around that problem and try to find other data points, that's potential, but extremely difficult. Technology and artificial intelligence in particular is only as good as the data you put into it. I think that's a point that's been made a few times. And one of the big issues with Asia historically has been there is a lack of data, which is exactly why folks like Deal Street do so well, because you're providing data, right? But at a granular company level, very difficult to get that type of data. And as a consequence, yeah, you get the big picture right, but as an investor, we don't make money out of the big picture. We don't make money as a macro investor. You know, if we did, our lives would be a lot easier. We make money out of company-specific circumstances, backing the right management teams, backing, you know, a very individual circumstance, getting data around that and comparing that individualistic data across a platform, extremely difficult.
Got it. Nigel, just wanted to ask you, in the VC world, you know, historically, be it Southeast Asia, China, or the US, success has largely been driven by a relatively small group of individuals who have access to the best deals, who can sort of come into the best deals early. And in this context, like, can tech platforms or solutions sort of break the structure, maybe provide greater access to deal flow to a larger investment community, or can even, and the second, can even tech like sort of help, because these are very early stage companies. Can you sort of use tech to make investment decisions by sort of integrating your insights with some level of AI or machine learning models on how these companies can do going forward in the next 3, 5, or 10 years?
Look, you know, I'd love to say yes. And, you know, having been a previous, you know, chief information officer many years back, I just want to know that technology can solve every problem. The reality, though, is that, as Abrar rightly says, you know, we can have, being sector specific helps. You know, Abrar's described in the healthcare sector. I'm sure that he and his teams already have a huge scan of information about who's playing in the marketplaces for each of the individual parts of the vertical value chains against the individual themes. But ultimately, a lot of the information is private, and it's very hard to figure out how anyone's going to step into that space, make that information public in an accurate enough level that it can become predictive. I mean, it's hard enough, I think, in the VC space in particular, it's hard enough without going and talking to management teams and getting a gauge on whether or not the management is capable of riding a cycle through and growing a business, to then step back and say, let's allow machine automation to go and make some predictions around these things. So my personal view is not in the near term. It's not going to have an impact. In the discovery phase, maybe, but in terms of decisions about whether or not individual companies are going to do better or worse, I just can't see it happening. I think being across a sector gives you the best chance of being able to get access to better deals in that sector. But outside of that, I'm not quite sure how a generalized AI can actually help solve any of those problems.
Got it. Adam, last question to you on this. We've been talking about, it's been for years, people have been talking about whether the traditional venture capital industry can actually be disrupted. You've heard what Nigel Abrar said. What are your thoughts? Can AI or tech actually disrupt the traditional VC space?
You know, I think it can certainly speed up the work that certain VCs do. You know, going back to the earlier point Nigel said about maybe it was during the pre-call, but you know, every portfolio company that you talk to presents you with a hockey stick projection, right? And so I think from a VC perspective, you can get very lost in that kind of projection and rosy outlook. But the work, the hard work is actually, you know, digging deep into these companies. And I'll give you an example where AI plays a role. It's in, you know, after the talk, after the initial relationship with the team, it's finding out, for example, you know, is the ARR, the annual revenue, recurring revenue, really true? And we had a situation where a company presented, you know, their ARR as very rosy, but, you know, after a quick diligence using eBrevia, you can see that, you know, their ARR, the term of their customer contracts, by and large, were 6 months or less. So, in that case, is it really ARR or is it really, temporary revenue, right? So if you're just relying on relationship, if the traditional VC is just relying on relationship and a sampling of customer contract, you might not get there. But if you're using, with AI, you can quickly go through large volumes of contracts and have a more thorough and accurate review. Then you can make decisions, based on facts and not based on just, your gut feeling about a team. Because we've seen, in the last year with WeWork, and there's some other companies that, have crazy valuation, have very charismatic founders that really led VCs and other investors down a treacherous path. And so I think with AI, VC can make decisions that are more fact-based and more with greater speed. And I think that's going to differentiate, the more effective, profitable VCs from the ones that, are just kind of operating based on gut instinct. So is it going to revolutionize the VC industry? I wouldn't go that far, but I certainly think that it would differentiate, between the powerful players and the ones that are going to fall behind.
Got it. I'm just going to take a very interesting audience question, very related to what you said, Adam. I'll throw it open to all three of you. Anybody can take it, in the sense that in the post, once the deals are done, when it comes to both the PE and the VC players, how much are you sort of using tech to look at the risk returns attached to certain investments, or maybe mapping certain markets or financial modeling for your portfolio? How much of tech do you see PE and VC firms use here?
I think a lot. I think that when, I think even more so than during the acquisition phase, because in the acquisition phase, it's about, speed and going through and doing the deal quickly, right? But the hard work is actually afterwards, right? If you're looking to improve the P&L of the companies, change management teams, changing the customer mix. There's a lot of room for machine learning and AI in terms of, looking at new markets, looking at new customer segments, understanding what you have already when you bought the company, right? A lot of, I think a lot of PEs and VCs, after they bought the company, they tend to look at the risk, but not the opportunities that are sometimes contained already, missed opportunities. I'll give you an example. There were contracts that we found that had automatic increase, step-up increase in charges upon renewal. And the company just didn't know that those clauses existed in their contract. So, they were not capturing the revenue. So just by going through hundreds of customer contracts, they were able to increase the revenue, based on existing customer base. You don't even have to go beyond the existing customer base. So understanding what you have, I think, has been a big challenge for companies, for portfolio companies, right? So in order to manage them properly, I think there's a huge role for technology, especially AI and machine learning.
Got it. Just two more quick questions. Both this is to Abrar and Nigel. Very quick audience questions. One of our viewers has written in asking that both Quadria and Apis, you manage specialist funds. Quadria more in terms of healthcare, and Apis in terms of the payment space. You think that's that's going to be a unique advantage to be specialist in the post-COVID phase for GPs? Both of you, Abrar and Nigel.
I'll go first, Abrar, perhaps. And I mean, I think it's an advantage right now in the COVID situation, because in a situation where you're having to talk to companies and do diligence on companies where you can't necessarily meet with them, having a specialist view in the market space, having a knowledge that allows you to be able to quickly understand what a company does and why it does it, and having looked at enough of these companies across enough sectors to know whether or not to benchmark metrics of this company versus another, allows you very quickly, if you're a specialist fund, to be able to make decisions even remotely. So I think right now it's actually a very good advantage, I think, to have a specialist focus. Going forward, I mean, my personal view is that if you're operating in the emerging market spaces and operating across multi-geos, I actually just personally think that having some specialization will allow you to have a better chance of succeeding, both in terms of discovering companies that you can invest in, but also in terms of being able to know how to take learnings from one of those sectors in one geo and be able to translate them to companies in another. And we're seeing that actively happen. We've seen it in both our portfolios, and I think we'll continue to see it.
Abrar?
Yeah, look, I think you're asking both of us, who are arguably both biased, since we both represent sector-specific funds, but I would say without a doubt, in any context, being specialist beats being a generalist, and I'll give you the two big reasons why. The first is, we represent being a capital provider, and when you're a capital provider, you're working with an entrepreneur who has a lot of choices, and if you are seen only as a capital provider and not someone who can actually add tangible value in that business because you understand that sector, you understand that space, there is some history that you have, and therefore you can add some value. If you're only representing capital, it is harder for you to establish that relationship. And in the end, you have much less to offer. You only represent money. If you're a specialist investor, hopefully you represent a little bit more than money. Hopefully that represents you getting access to better quality deals. But more importantly, because you can add that value, you become a preferred partner to the entrepreneur. That's the first thing. Actually, on the other side, which is with an LP, I think one of the first things that we also recognize that when you're setting out now, when you're setting up funds in your first fund or your second fund, it is very difficult to have a generalist strategy because you will be compared with everyone else that's out there, and LPs will say, why should I invest in you versus someone else? But if you have a differentiated strategy, and that does not mean sector specific, but if the strategy is differentiated, we took the pathway of sector specific. But if it is a differentiated strategy, then you've got a credible argument to make with LPs as to why you're better positioned to execute on the opportunity than someone who's just doing a generalist strategy. So for both those reasons, both fundraising, but more importantly, execution, I think being sector specific helps and actually transcends COVID. It's beyond COVID. It was valid before COVID. It's going to be valid after COVID.
We are past 12 noon Singapore time. Just bear with me. I want to take one more audience question. This is from Dinesh Tiwari. Thank you for sending it in. This is to Adam. Adam, can you quickly, you've talked broadly about how tech or AI can help, but can you share if you have any specific examples how a GP has made use of these technologies to make a difference in a specific investment situation?
So yeah, at the risk of repeating some of the things I said before, but it comes down to the reputation of the GP to be able to do deals quickly, to whether passing on a deal or moving forward the deal. I think that the GPs that use technology like ours really effectively are the ones that see themselves in auction situations where they're able to go in, assess the deal really quickly and give it a quick yes or no answer. And that GP has a reputation in the marketplace that, hey, they can do things quickly, they can act decisively. And then if they move forward, they're able to execute the deal quickly between signing and closing, right? And so being able to deploy technology to perform diligence quickly, I think is also key. One of the things that portfolio companies dread is just, ongoing diligence that drag on for months and months and months between the term sheet and the time that the purchase agreement is signed. So being able to execute deals quickly with technology is one of the benefits that distinguish a good GP from one that's that investors and portfolio companies tend to stay away from.
Yeah, we're 4 minutes into added time. First, I would like to thank all our three panelists. Thank you for being generous with your time and expertise and joining us for the session. Nigel, thank you so much. Abrar, thank you for joining us. And Adam, I know it's very late in the US. Thank you for joining us.
My pleasure.
For all our audience, thank you again as we come to the last webinar of this year. Make sure that you join us for our virtual summit next month in the month of November. And hopefully we'll see you there, and watch out for the video and the transcript which we will share with all our readers in the next couple of days.